So this video is going to be a presentation that I made. It's going to be a renting versus a house hack scenario. Very specifically, this person on TikTok this week told me that they pay $1,185 per month in rent. So what we are going to do is we're going to compare this $1,185 monthly rent, and we're going to see what it looks like compared to this fourplex that is on the market right now in Fayetteville, North Carolina, listed at $465,000. So we're going to go over analyzing the property, see what the mortgage would cost. We're going to see what the incoming rents in the area look like. So we're going to do some comparable shopping, and we are going to analyze the property itself to see if the rents versus the mortgage makes sense, and then we're going to see and then at the end, we're going to look at what qualifying for this mortgage looks like. And then very specifically, we're going to look at using the VA home loan to purchase this property and getting qualified with the VA home loan and some stuff that I've done in the past, my family's done in the past, to use their VA home loan to buy 2 to 4 unit properties. So let's check it out. Very first thing is we're going to go over what the VA home loan house hack strategy actually is. So kind of self-explanatory. Again, we're going to go use this property here is going to be the subject property. We'll just call it the fourplex. So the VA home loan house hack strategy is you are going to buy a 4-unit apartment building or a duplex, triplex, of course a fourplex, with $0 down. You're going to live in 1 unit because the VA home loan is an owner-occupied loan. If you are using the VA home loan, the VA guidelines are that you do have to occupy the property for some time. So you live in 1 unit, you rent out the other 1, 2, or 3 units, and you collect the incoming rent to offset your mortgage. And it is, 1, it will probably make your living expense lower, but 2, sometimes you can even cash flow or be positive while you live there. So it's a very powerful tool, and you can do this with the VA home loan. So let's look at what the mortgage payment on this property would look like. So again, we are looking at a $465,000 purchase. And as of today on mortgagenewsdaily.com, looks like a VA home loan interest rates are at 6.13%. So that's what we're going to use for this calculation. Just as a side note here, but you can check what the daily interest rates are for different loan products, but that is the base rate. So it is not going to be that low typically. There's going to be charges on top, so it's going to be a little bit higher. For this property specifically, I checked the Zillow listing and I saw that the monthly taxes are $300 a month and the monthly insurance is estimated to be about $155. So that's what we're going to use in this presentation for this specific scenario. So that's going to give you a total monthly PITI of $3,282. So for those of you who do not know, the PITI is the principal, interest, taxes, and insurance, or most people know it just by the mortgage payment. So if you're making a mortgage payment monthly, most likely you are paying your principal and interest, your taxes, and your insurance. So by the way, if you do not have a mortgage calculator that you use, they're very easy. They're very easy to build in Google Sheets or Excel. But if you want this one, it's on my website, vahomexprt.com. You can request a copy, or you can just use the copy that we have on the website there. But the mortgage payment for a fourplex in Fayetteville, North Carolina is going to be $3,282 per month. That is your cost of ownership. Then we're going to do some comparable rental property shopping. So what I do is I go to Zillow.com or apartments.com and I find the subject property. You can see here the little red pin is where this specific property is at. So we can see around there's 4 different listings there for rent in the area that are float around the $1,100 to $1,200 a month. So as a conservative rent number, I'm going to go with $900 per unit. So what that means is that based off of this analysis that I've conducted, I can conservatively account that I can live in unit 1 and rent out unit 2, 3, and 4 for $900 each per side. So that would give me a total gross rent of $2,700. Gross rent is your total incoming rent before any expenses. So again, our gross rental income for this scenario would be $2,700 while you are living in the property. So let's put it all together. With a monthly mortgage payment of $3,282. Unit 1 is where you are going to live, as we discussed before, and then unit 2, 3, and 4 are each going to be rented at $400 per month. So again, that's going to give us a total gross rental income of $2,700 every single month. Then to find our cash flow, we're going to take our gross rental income and we're going to subtract our monthly mortgage payment. So that would be $2,700 minus the $3,282 gives us a negative cash flow of $581 per month. So that is not a bad thing. What that means is, since it's a negative, so that's not a bad thing. All that means, so what that means is that it's going to cost you $581 per month when you live in Unit 1, and Unit 2, 3, and 4 are paying you $900 every single month. So what that looks like on this spreadsheet right here, this is a spreadsheet that I built to analyze 2 to 4 unit properties whenever I'm using my VA home loan to do a house hack strategy, and then what several clients of mine use in my family as well. So you can see here at the sales price is $465,000. The loan amount is going to reflect the same number. The down payment is going to be 0, of course, because the VA home loan is a no down payment loan. Moving down to the taxes and the insurance, we have the $300 and the $155. Going down to the income column, we have Unit 1 blank. Again, we're living in Unit 1. Unit 2, 3, and 4 are rented at $900 each. At the very bottom, we can see our debt service and our PITI. Moving up to the very top at the green box here, it says owner occupied, parentheses, while you live there. So we can look at this example here and we can see what our cap rate and our monthly cash flow while we live in the property. We're going to see the same negative $580. That's what's left over after the mortgage payment comes out. So real quick, if you want a copy of this spreadsheet, you can have it. It's on my website, 100% free, vahomexprt.com/property analyzer. It's 100% free. Put in your email and I will send you a copy. It's helped me analyze 2 to 4 unit properties. It saves a ton of time. So get your copy. It's 100% free. But the overview, after looking over everything, we can see that the monthly rent of $1,185 or $14,000 a year doesn't make a lot of sense whenever we're comparing it to a $581 per month living expense, or almost $7,000 a year. So it's over half of the amount. So this is just a very, very small example of why just buying real estate is a better alternative to renting. We're not even getting into appreciation or tenants paying down your debt or anything crazy like that. Just the surface level numbers of renting out other units, collecting rent from tenants to pay down your mortgage far, far exceeds paying rent to your landlord. So if you've been paying attention, this probably makes a lot of sense. You can make a lot of money doing this, but if you're actually paying attention, you're probably asking yourself, how can I actually get approved for a $3,200 a month mortgage payment when I don't make that much money? Which is a pretty logical, fair question, because you don't want to pay $1,200 a month or in rent, but $3,200 a month is a hard loan to qualify for. So what we're going to do now is we're going to go over the approval process and some tricks that I haven't seen a lot of people talk about, how you can do this for yourself. So this is just a disclaimer. This is not advice from a mortgage loan originator. I am not a mortgage loan originator. I am a real estate broker that has happened to use the VA home loan a few times personally in my family. So I can introduce you to the mortgage lending teams that have helped me do this, but this is for educational purposes. And if you want to do this, I will certainly help you, but this is not mortgage advice. By the way, if you are still here, like this video and subscribe. It will really help out my channel, and ultimately it'll help out a lot of other veterans and service members to really get the most out of their VA home loan benefit, which is really what it's all about. I read somewhere that only 13% of eligible veterans and service members actually use their VA home loan, and it's such a powerful thing when it's used correctly. So like this video, subscribe to this channel. It really helps me and it'll help others too. But let's talk about how to get approved for this big mortgage. So for this scenario, we are going to assume that the borrower is an E4 active duty income that has been enlisted for at least 4 years. The base pay for an E4 is $3,500 per month. They're married, they have a dependent, they're married, so they are making $1,700 a month at BAH. So you can see right here, it says grossed up 25% equals 2125. So what that means for any income, whether it's BAH, BAS, VA disability, Social Security disability, this income can be grossed up 25% for lending purposes because it is tax-free. There's no money that's being deducted out of that. So we're going to take our BAH, and for qualification purposes, we're going to gross it up 25%. And then we're going to take our BAS, and we're going to do the same thing. We're going to gross it up 25%. So these are our three qualifying incomes right now, and we're going to take them and we're going to add them all together and give a total qualifying income of $6,230 per month. Okay? So that is our qualifying income. That just means that is all of the income that this service member can use for this loan. Then we're going to, okay. So for those of you who do not know, shouldn't be very many, but this is an LES, a leave and earnings statement, or an LES. This is where you can check to check on what your base pay and your BAH and your BAS allowances are. If you do not know those, this probably isn't the best video for you, but just thought I'd put that in there. So once we have our qualifying income, what we're going to do next is put in the debt to income ratio. So we're going to take our total qualifying income, the number that we just determined, the 6,200, and we're going to multiply it by 30%. 30% is a conservative number. I think the VA home loan guidelines allow up to 43%, and some people suggest below 30%. I'm not saying that you should do this or you should use 30%. I'm just saying that this is what we're using for this situation. So take your qualifying income and multiply it by 30%. That's going to give you $1,869 of allowable mortgage payment. This part's going to be very, very lender specific with credit scores and other outlying factors, but this is a good starting point or a good reference point to really understand how much you can get approved for. So then once you have the allowable monthly payment, you're going to take that number and subtract any of your monthly debt obligations like your car payment or any credit card, maybe child support. So just as an example, just so we can see what it looks like right here, we're going to say that the car payment's $800 and the credit card payments are $800. You're going to take your allowable monthly payment that we determined, the $1,869, and then you're going to subtract your monthly car payment and your monthly credit card payment. In this scenario, would be $1,600, and you'd be left over with a $260 a month allowable mortgage payment that you can pick up. So, not a good scenario, but it's just an example of how that would work. So, but moving on. So now we know how much we can get approved for, and we know how much the mortgage is going to cost. But if you've been paying attention, you know by now that there is an issue at hand, that our approval amount is only $1,869 a month is what the bank says we can afford, which is about a $240,000 purchase price. And the property that we want, this multifamily property that's making $2,700 a month, we need to show that we can buy $3,200 worth of mortgage payment every single month. So this is a big issue, of course. We are $1,300 short from the goal. That's not good. So the logical explanation here is that the rents from the property should go towards my income qualification amount because I'm buying a property that's paying me every single month, right? So luckily for you, the VA home loan guidelines do agree with you, and most mortgage lenders do agree with you. Right here it says lenders allow 75% of incoming rents for qualification purposes. That should say my lender allowed me to use 75% of incoming rents for qualification purposes. Not all lenders are going to have these rules, these overlays, but I can introduce you to mortgage lenders that do have these overlays that can do this for you. So again, in this scenario, in my scenario, we're going to say that the lender allows 75% of the incoming rents to be used for your borrowing qualification purposes. So what does that look like? Again, Unit 1 is where you live. Unit 2 has an income of $900, as we discussed before, and we can only use 75% of that income. So we're going to multiply the incoming rent by that 75%, which gives us a $675 that we can add to our monthly buying amount. But we can also do it for Unit 3 and Unit 4. This gives us over an additional $2,000 that goes directly towards your monthly allowed debt obligation. So once we go back to the chalkboard and we see our initial approval amount is at $1,871, and then we add in our rental credit of $2,025 that we just calculated, we can see that our total buying power, we are now eligible for $3,800 in allowed monthly mortgage payment. And then we can see, going back, we can see that this property, this $465,000 purchase price is only going to cost us that $3,100 or $3,200 a month mortgage payment. So that's plenty of room. There's $600 a month in there that we have wiggle room to play with. And that is how you can use the multifamily incoming rents to go directly towards your buying power to help you buy a bigger amount. Because you're going to find that when you go to buy 2, 3, or 4 houses at a time, that they are going to be tremendously more expensive. So you have to use these incoming rents to increase your buying power. It's very powerful. So we're going to look at it, what it all looks like all together. So step 1 is you're going to take your base pay and you're going to add it to your BAH and your BAS. That's grossed up that 125%. So that's going to give you your qualifying income. Next, you're going to take your qualifying income and you're going to subtract your monthly debt obligations. And that's going to give you your monthly allowed mortgage payment. Again, this is before the rental income adjustment. So then step 3, we're going to come down and we're going to find out what our rent income really is. So we're going to add up all the incoming rents and we're going to take that times 75%, and that gives us our usable rental income. For qualification purposes, step 4, we're going to add the allowed monthly payment that we determined in step 2, and then we're going to add it with the usable rental income that we determined in step 3, which is going to give us our total allowed monthly payment. So this is the secret sauce. This is the formula. Right now, screenshot this so that you can go to the drawing board. You can reference this right here. It just took me a little bit of time to turn into words and put it into a very simple sheet, but screenshot this right now so you can reference this whenever you're analyzing these properties and figuring out what your income is. And lastly, what about after I ETS or PCS, when I want to do it again, or I want to move out, or me and my wife want to move, or I want to go do anything else. So you do have a few different options. So obviously you want to rent out the 4th unit so that you can collect the most rent. So you'd be at 100% occupancy. So if rent never changed, you'd be collecting $3,600 a month in rent. And then you would subtract your monthly mortgage payment of $3,282, and you'd be a positive cash flow of $318 per month. And then again, referencing the spreadsheet right here, this is what this would look like. Referencing the very top right corner, again, we're going to look at the non-owner occupied portion where we can see our cap rate and then our monthly cash flow showing that $318 a month. Again, if you want that spreadsheet, it's on my website, vahomexprt.com, property analyzer. So the big picture, renting $1,185 per month is an absolute downfall. It does not make any sense at all. You have the opportunity to make your living expense less than half of what that actually is. And then again, PCS, ETS, repeat the process. You can use your VA home loan multiple times. So, I've had 2 VA home loans at a time. My brother's had 2 VA home loans at a time. My father's had 2 VA home loans at a time. You can do it. It's not against the rules. It's not unethical. You can do it. Lots of people do it. So don't let anybody tell you any differently. Now, qualifying for 2 VA home loans at a time is a different story, but you do have the option of using 2 VA home loans at once. But after you move out of the property, you rent it, now you're making an extra $300 a month in rent. So it's a very powerful, very, very powerful thing, especially if you're PCS and you're planning on staying in the military another 10, 15 years. You can do this every other year, every 2 years, every 4 years, and it accumulates. It would pair well with military retirement or your VA disability income. And lastly, just something to think about. When you're renting, you are paying somebody else's mortgage. The chances are that the apartment complex that you're renting for $1,100 a month, chances are that the owners do not have it paid off. You know, the owning several $1 million worth of apartment buildings and having them free and clear is very, very unlikely. So whenever you're paying a landlord, when you're paying rent, you're just paying somebody else's mortgage. So, you know, something to think about would be, why not just be the landlord yourself whenever you have the opportunity? So paying off your own mortgage is going to make a lot more sense than paying off somebody else's. That's just something to think about. But I know we went over a lot of information in this 25 slide presentation here, but this is why buying a multifamily property makes more sense than renting in Fayetteville, North Carolina. And this is how anybody that is over the rank of E4 that's been in active duty for over 4 years can do it. So if you want to know exactly how you can do this, I schedule calls with veterans and service members 7 days a week to discuss their VA home loan opportunities. I have never, ever, ever charged a VA home buyer for any services whatsoever. My name is Dylan Sievering. I'm a North Carolina real estate broker. I guide veterans and service members through their VA home buying transactions. I've used the VA home loan several times, and I want to help you do the same. So go to my website at vahomexprt.com, schedule a call with me one-on-one, or you can just text me. My number's pasted all over my website, all over this channel. If you watched this far, like the video, subscribe to the channel, comment anything, doesn't matter, just comment anything. If you have any questions, of course, let me know in the comments. If you disagree with anything specifically, please put it in the comment. I love to argue. But thanks for watching.